If you stay in the stock market long enough, one realization becomes unavoidable. Different stocks, different years, different countries, yet the same mistakes repeat. People buy when prices feel safe, people sell when prices feel scary, and people wonder why outcomes never change. This episode exists to break that pattern. Because markets do not move randomly, they move in cycles. And once you understand cycles, you stop reacting emotionally and start thinking structurally. Why this episode matters more than most. Many people learn indicators. Some learn fundamentals. Very few learn where they are in the market journey. Without that awareness, buying feels stressful. Selling feels regretful. Confidence disappears quickly. This episode gives you context, and context changes everything. If you want to understand why the market behaves the way it does, not just what it does, stay with this till the end. The market is not a line, it is a loop. Most beginners imagine the market like a straight road. They expect steady progress, logical reactions, smooth movement. But markets don't move forward endlessly. They loop. They rise, pause, fall, and reset. Not because of chance, but because of human behavior. Markets are reflections of collective emotion expressed through price. What exactly is a market cycle? A market cycle is the natural sequence of price movement driven by optimism, confidence, excess, and fear. These emotions do not appear randomly. They emerge in order, and price follows that emotional order. Understanding cycles means understanding people, not charts. The four phases that control every market. Every market cycle has four phases. They appear in individual stocks, sectors, indices, entire economies. These phases are accumulation, markup, distribution, and markdown. Every major rise and fall you have ever seen fits into this structure. Phase 1. Accumulation, where wealth begins quietly. Accumulation starts after pain. Price has already fallen, sentiment is negative, hope is weak. This phase feels boring. Price moves sideways, lacks momentum, attracts little attention. Emotion here is dominated by disappointment, distrust, fatigue. People say, "This stock is dead. Nothing will happen here. There are better opportunities elsewhere." Retail participation is minimal. This is exactly when long-term participants become active. They accumulate slowly, without noise. Why accumulation is ignored by most people? Accumulation offers no excitement. There are no dramatic candles, no exciting stories, no quick rewards. Most people are conditioned to act only when they feel confident, but confidence is absent here. That is why accumulation rewards patience, not intelligence. If you've ever felt bored and ignored a stock that later surprised you, this phase explains why. Phase 2. Markup, where confidence returns. Markup begins when demand overtakes supply. Price breaks out of ranges, begins trending upward, shows strength. Gradually, attention increases. News improves, narratives change. You start hearing, "This looks strong. The company is doing well. The market is healthy." Retail participation increases. Emotion shifts from fear to hope. This is the phase most people enjoy. Why markup feels so comfortable? Because price confirms belief, profits appear, confidence grows, success feels deserved. This comfort attracts more participants, but comfort also hides risk. As price rises, caution reduces, position sizes increase, discipline weakens. This comfort plants the seed for the next phase. Phase 3. Distribution, where optimism peaks. Distribution occurs after an extended rise. Price continues upward, becomes volatile, struggles to make progress. Emotion is extremely positive. People say, "This time is different. It will keep going. There is no reason to worry." Participation reaches its highest level. This is where new participants feel safest, but this is also where experienced participants reduce exposure. They distribute positions gradually, without panic. Why distribution is the most dangerous phase? Distribution is dangerous because optimism feels logical. Warnings are dismissed. Risk is underestimated. Retail participants often increase positions here. They confuse popularity with safety. High participation creates confidence, but not protection. This phase traps more people than any other. Why market cycles never stop repeating? Markets evolve. Instruments change. Technology improves. Human emotion does not. Fear and greed repeat endlessly. That is why charts from decades ago still look familiar today. Cycles exist because people exist. Why most people are shocked by market turns? Beginners often say, "Nobody saw this coming. This was unexpected." But reversals are rarely sudden. They develop while emotion dominates attention. Markets turn quietly. Emotion turns loudly. Understanding cycles removes surprise. Why time frames do not change the structure? Cycles exist on all time frames: minutes, days, months, years. The structure is identical. Only duration changes. Once you understand this, you stop overreacting to short-term movement. Why news follows cycles? Positive stories dominate near peaks. Negative stories dominate near bottoms. This is not manipulation. It is reflection. News mirrors emotion more than it drives it. Why chasing ends the same way? Chasing happens when people act on excitement. They enter late in markup or distribution. At that point, reward is limited, risk is elevated. Markets punish chasing because chasing ignores structure. Why patience is not optional? Patience allows observation instead of reaction, preparation instead of panic, alignment with cycles. Impatience forces action without understanding. Markets reward patience more consistently than speed. If this is making sense, if you're still listening carefully, it means you're not here for shortcuts. You're here to understand. That mindset is rare and powerful. People who understand cycles stop blaming the market and start adapting to it. What comes next? Now you understand who moves prices, how cycles work. The next step is learning market structure and trends. That is where charts stop feeling confusing and start becoming meaningful. Stay connected to this series because every episode builds directly on the last. Final thought. Markets do not punish people randomly. They reward those who understand rhythm. Those who ignore cycles feel lost. Those who respect them feel prepared. This is episode 3. The foundation is no longer weak. The next episode brings precision.
Thank you for watching. Like, subscribe, and share to get similar kind of videos.